Because unlike crypto bears, whales do hibernate for the winter. We're back. Let's start the show. Welcome back to the Crypto Times. Long time no see. Now, I'm still the Crypto Baron, and here we are at a time where it seems like everyone is talking about cryptocurrency.
Hodl gang, hodl gang, hodl gang.
Now, I want to talk today about value because despite millions of variables created by both internal and external factors that create the pumps, create the dumps, and the entire price discovery process that we're essentially experiencing is just basically a case study in the maximum appreciation of a new emerging asset class. It's been about a year since I first created the Crypto Baron persona because I couldn't stop bothering friends in real life about crypto, and quite frankly I just needed an outlet to talk about it. So if you go back and look at some early episodes, you'll catch some gems like PIVX for pennies, or leaking the Litecoin Coinbase news, or interviewing Charles Hoskinson for hours before Cardano even came around. But maybe none are more relevant than episode 5, where we try to define the market share potential of all of cryptocurrency. So exploring this valuation is what really turned me into a super bull in the crypto space in the first place. I'm convinced that the floor valuation for cryptocurrency is $10 trillion, and more accurately in the several hundred trillion is probably what I think is a much more realistic future valuation of these. Now, I've covered this previously in far more detail, but I believe the whole market share potential of the legacy financial system, from M1 and M2 money supplies to debt and equity global markets and derivative markets, measure in the quadrillions. So even to capture 10% of that market share with a far technologically superior product, with transparency, privacy, and even more functionality, I think this is going to see even further growth, to be honest, because there's also markets that we haven't even expanded into that we will be expanding into. Things like the Internet of Things, things like AI, things of that kind of nature. Universal basic income, for example. So anyway, back then, when we first started the channel, the markets were only around 20 billion, and my bullish estimates for the year were that we would finish at around 100 billion, which back at the time seemed crazy. Now, in less than a year, though, the markets broached the 800 billion mark in January before crashing down to where we are now, at a suspiciously similar time to last year under suspiciously similar events, quite frankly. In fact, this time last year, Bitcoin was about to get kicked by the SEC for the Winklevoss ETF denial, just like they released some FUD just a week or two ago to the markets recently. So as you're all aware, though, I put zero value in technical analysis because you're investing in the future and not the past.
Let the past die.
Yes, thank you, Ben Solo, exactly. So while I openly admit this is valueless, it is probably at least worth noting that the altcoin explosion of 2017 was only weeks from where we are now. So it'll be interesting to see if there are maybe some subtler macroeconomic effects that are having a broader impact than we realize at play, like Chinese New Year, or maybe people are waiting for a new year to sell for a new tax season that won't be due until 2019 as opposed to this coming April. Or on the other hand, maybe we'll see a boom from tax return investments. So these are some subtler things that it's worth trying to see what kind of impact and isolating those potential variables. But for now, the case for bulls, something that I really want to touch on because it's all things that I fervently believe in. Now, the reality is that the infrastructure keeps expanding, and despite all the barking that the SEC or the People's Bank of China may do, they actually have little bite in terms of decentralized systems, and as we inch closer and closer to mainstream regulatory conciliation, maybe the best word. I wouldn't say compatibility or compliance are in the cards, but a mutual understanding, perhaps, maybe regulating fiat gateways like exchanges. And then once that comes around, we'll all move on to DEXs anyway. So it's an exercise in futility trying to play catch up with a field that develops in tech this fast. But I digress. The closer we get to this conciliation with regulatory authorities, though, the closer we do get to mainstream investment vehicles. And when I worked as, speaking of mainstream investment vehicles, when I worked as a mainstream financial advisor, one thing all firms are very focused on right now is the transfer of wealth. At Merrill Lynch specifically, developing relationships with potential heirs was hugely important because we're about to experience the baby boomer to Gen X and millennial transfer of wealth, and it's going to be the largest in human history. So while you have this taking place on one hand, you simultaneously have the rise of a millennial generation who a Forbes survey showed is more interested in investing in Bitcoin and cryptocurrency than stocks or bonds from the legacy financial system. And further, we see Coinbase developing a crypto index. This is important because Coinbase has been able to establish a substantial mainstream foothold, and it's got a strong trusted reputation and brand, and quite frankly, because of how ETFs work, they are kind of like the socialism of capitalist markets. So ETFs have become widely popularized in finance recently because of the positives, but people don't really look at the negatives involved. So what you do, instead of trying to identify individual winners, you can just pick a sector you feel bullish about. So tech as an example. Instead of investing in Microsoft, you could invest in a tech ETF, and you can experience gains from Microsoft, Intel, Apple, etc. The problem is it's created like a welfare system for companies within those ETFs, and it's inflated their valuations. A poorly performing tech company that's not delivering will still receive some decently broad investment just because it's a part of that ETF or index, and not necessarily based off the merit of its own performance, which also makes a compelling bull argument for altcoins and when this crypto ETF comes. As long as you're a part of a coin that's going to be included in the Coinbase crypto ETF, you'll get a lot of exposure to new money and probably some solid pumps. The point is, this is all still very, very early, and cryptocurrency as a whole is headed so much higher, and for so much more adoption, and for so much more development and infrastructure improvements and cheaper transactions, and so much more to come. So in the meantime, until that day comes though, you've just got to be able to see a BitConnect coming on your own. I mean, part of me is skeptical that everybody involved in that didn't. You know, at some level they kind of had to know. But anyway, so there are internal and external factors at play. So let's try to identify some of the factors that we've seen so far in 2018. So first of all, we had South Korea ban, I believe was the first in January.
Can you state categorically? You are fake news.
and then an India ban.
Can you state categorically? You are fake news.
And then China ban number 214.
Can you state categorically? You are fake news.
Now that one was perhaps the most impressive FUD yet. Someone managed to hack the PBOC to send out a fake email about a Chinese pending government crypto crackdown, but it wasn't real. Now, of course, the markets didn't know that, and we're once again still paying the price, just as we did with the fake South Korea and the fake India bans by some clever shorters with some solid resources. Now, this was just 2 months old. The Tether Bitfinex subpoena that actually took place in December, but the news kind of came out, I want to say it was early February, and we all know something fishy is up with Tether, but the timing of the release 2 months late by Bloomberg is extra suspicious. What motivations could Bloomberg have to try and crash the crypto markets? Now, one bit of news that wasn't fake was Mt. Gox liquidating tens of thousands of bitcoins to settle debt with creditors. It's not the external factors that present the greatest threat to decentralized systems. It's actually the internal ones. The blockstream versus the big blockers scaling debate, civil war for Bitcoin, for example, or Ethereum, ETC, code is law versus intent, civil war that both still continue. It's the poorly run Mt. Gox. It's the ICOs with boatloads of money and no product. Now on the bright side, as internal factors, these are the factors that we as a broader cryptocurrency community can control. And if you've been watching this channel, yes, you've made a boatload of money, but be more discerning with it. Always. This is one of the simplest ways that we can work together to police our own community. And that's it for now, guys, but lots to discuss in the future, so I will be back. Maybe we'll even touch on the incredibly fascinating lawsuit that the Craig Wright Photoshi is experiencing by the family of actual potential Satoshi Dave Kleineman. When Craig doctored those archived websites back in the day to make himself look like Satoshi, he leveraged Dave because he was already deceased, so he couldn't come out and openly dispute it. However, if you take those hoax documents that Craig forged at face value and pretend he is Satoshi and built this with Dave Kleineman, now the Kleineman family does have a potential claim to the $10 billion at stake of Satoshi's fortune. So now Craig, by extension, has to... An oversimplified explanation, but to me the most interesting aspect of this trial is that on some level the identity of Satoshi Nakamoto himself is what's on trial. And it's definitely not Craig, but it's possible there was Kleineman. He fits a lot of the criteria, and his death explains the untouched Bitcoin hoard